Hello, everybody. Welcome to today's webinar brought to you by Bursa Malaysia and managed by our company LifeChamp. Our webinar title today is Complement Your Property Investment with Real Estate Investment Trust. So welcome, everybody. My name is Shen Chu. I'm the moderator for this webinar. Now, how many of you here are already a property investors? You may type 1 in the chat box if you are already a property investors. Okay, let me know if you already invested in properties before. Wow, there are many of you here who are already an investor in property. Now, today, we're going to talk about an alternative way for you to invest in property through real estate investment trust and how you can use it to complement your property portfolio. So disclaimer, whatever we share in this webinar is only for educational purpose. So in no way that we give any recommendation for you to buy or sell any listed securities that we mentioned here. If you decide to make any investment decisions, you're 100% responsible for all your investment risk. Allow me to briefly introduce our speaker today. He graduated with a bachelor degree in finance and investment, and he also completed the CFA program on 1 and 10. Over the 5 years of investment experience, he has a focus on trading Malaysian and American stocks, commodities, index futures, and by applying fundamental technical analysis. He has over 2 years of investment teaching experience to over 500 students, and he is also an expert in wealth management and financial planning. So it's none other than Mr. Dibo Chua. Dibo, how are you today?
Hello, Shane. I'm good. Thanks for having me.
Yeah, good to have you here in our session. So without further ado, let me just hand over the session to you.
All right, sure. Just a while. I'll share my screen right now. Okay. Slightly lagged for my PC here. Okay. Okay. Yeah, so the screen is up, right?
Yes, that's right.
Okay, sure. No problem. All right. So, all right, we will start our section for today. So basically today our title it's about REITs. How actually you can use REITs to complement your portfolio, especially your property portfolio. Okay, so basically throughout the whole section, right, we will keep on comparing REITs and property itself, and also we will talk about a lot whether REITs is better or property is better. So the whole section of it, the learning outcomes. So first of all, we will have what is REITs, of course, and then we will talk about what does REITs have. Okay, basically it means that what are the advantage that REITs actually have as compared to properties. And then the third one, we will learn about the types of REITs. Okay, there are a lot of different REITs in Malaysia. And also in the form of, let's say we go to the developed countries, they even have even more advanced kind of a REITs. So we will learn all of it. And then, of course, we will talk about the things that you need to know about REITs. So these are the things that like, how do you find a good REITs, and how do you, put up a good REITs into your portfolio? How do you monitor it? Okay. And then the last one, we will talk about the importance of REITs in your portfolio. Okay, so without further ado, we will start the section right away. Okay, basically before we start the section about REITs, right? So most of the time, I think whenever we have an idea to invest into property or REITs, this kind of asset, okay. So what does this kind of asset actually gives us? Definitely, it's not about the big, capital gain or the prices goes up and you earn a lot by buying and selling. Because to be honest, property investment, the best thing about it is, of course, first of all, if let's say you are already invested in properties, you know that you have the best thing if they have leverage. So for example, you get 90% of the financing. And then the second thing, it's basically the passive income. So we call like you do not have to work or do not have to even put up big efforts every day, daily concentration into the work, then they will just generate income to you already. So this is what we call passive income. And then the best thing about it is like, if you have passive income, and especially for the guys that actually at the age of nearing to their retirement. So this will then help you to really manage about your cash flow and then to achieve the financial freedom. Okay, so basically REITs, right? REIT investment, right? It's the best passive income asset that I would say it's very suitable for a lot of people. Maybe not to the young one, because the young one always they like to have the big risk, the aggressive risk. But passive income at the end of the day, when we reach to the age of like retirement age, we should start to have passive income. Then it will help us in terms of retirement and all these things. Okay. So basically, REITs we will focus on passive income, stability, sustainability, all these things. So first of all, we'll talk about what is REITs. Okay, so REITs, the full name of it is, of course, Real Estate Investment Trust. Okay, this is the full name. But basically, to be exactly the meaning of it, so REITs is actually, yes, it invests into properties, but it has the, I would say, the characteristics and the features of a unit trust. So this is what we call like investment trust. Okay, unit trust as in like mutual fund and all these things. The one that you know, that public mutual and all these things. Why? Because REITs, it is a pool of assets, pool of properties assets. Okay, real assets. That is a pool of it, and then they actually what we call securitization. They securitize it into smaller chunk of shares, and then give it to all of you. So the investor that buys into this kind of REITs, they actually own all these assets, all these real assets all together, but probably just by proportional. Okay, so this is what we call the simple definition of REITs. Okay, it's typically two things together combined. One is real estate, another one is unit trust, using the features of unit trust to build up into a fund. So this is what we call REITs. Okay, so as I say here, a REITs is a trust. Okay, so it's a trust, it's a unit trust assets class that is actually owns income producing real estates. Okay, they do not have any specific business, meaning to say they do not have like I'm manufacturing for furnitures or I'm manufacturing for computers. No, they only have property management. Okay, so typically their assets, their trust is just to own all these of assets and also to manage them. Okay, making sure that their assets is actually in good shape. Okay, and definitely REITs, they are traded in stock exchange. Okay, so if you want to buy REITs, you have to just open up your Bursa account. Then typically you can straight away buy REITs already. So they are in stock exchange. So example of REITs, they have different kind of assets. So typically we can have like many types of real estate, be it like residential, retail, commercial, office, industrial, warehouse, and all these things. So all these things will then classify as different types of REITs. Okay. And then the structure of REITs is also, as I said, it's like almost like a unit trust. So this is the shape of it. Like, first of all, we are the unit holders. Okay, we have the investment, we have the money. We give the capital to the REITs. Okay, there's also the REITs, they will have all this REIT manager as well. Okay, and then they will use our capital to go and buy properties. Okay, so definitely the properties, they will give up rental income to us, and then the REITs manager, they will then give us the dividend. It's what we call distribution. Okay, in this term, we do not call it dividend, we call it distribution. Okay, so then it forms a simple picture of a unit trust, something like that. Okay. And then definitely the millionaire questions is always this: why do we go for REITs instead of buying properties? Okay, because as we know, properties, you just buy a property, buy a residential, and then you rent it out. You will get rental as well, and you are getting monthly rental as well. Okay, even more frequency, right? Because REITs, as just an idea for you all, they do not give distribution, they do not give the dividend every month. Okay, because it's almost like a stocks, almost like a company like that. They will give the distribution probably like maybe every quarters. Okay, maybe sometimes they change their policy into like half a year, something like that. Most of it they will every quarter. But if you buy a property straight away, you get monthly rental, more frequency, right? Okay, easy cash flow also. better. And then also property, they grow better in value also, right? Because REITs doesn't seem like grow in value. They always like just stagnant only if you look at the risk price. But the following slides, I will then show you what kind of advantage that REITs actually have as compared to physical property itself. Okay, so basically REITs, as we all know, passive income, definitely passive income for freedom. This is definitely the thing that REITs, they also have. They will have the rental as well. So they receive rental every month from their assets, and it's managed by the REITs manager. So this is the similar things, the common things that REITs and property they have. But what about the difference? Okay, so the first difference that REITs actually has, it's the diversification of assets. Okay, meaning to say, if you imagine today you have a huge capital, let's say 100,000 or 200,000, you're planning about whether to buy property or REITs. So to buy a property, okay, definitely maybe you are buying like millions properties, so like 1 million or 1.2 million, something like that. So you have to put up deposits, okay. So the deposits, you put up like 100,000 or 200,000 for it, and then at the end of the day, you will then own the properties. But the property, it will be just one property itself, okay. What if like something happens? Maybe the management is not that good. They do not take care of the properties. Maybe it's like a condo, but the management is not good. They make it so lousy. They make it so many rules. At the end of the day, they don't take care of things as well. So your gym become like rosa, everything like bad condition. So this will then turns your property value down, because it doesn't give you an advantage anymore. So you will then at risk. Your investment will then at risk, and it will be harder for you to rent it out. But then for REITs itself, because it's a diversification of assets, they usually, one single REIT, they own many different kinds of assets. Maybe they own properties in terms of residential, they own a mall as well, they own an office as well. So altogether, even we are saying that, oh, the property market is very bad, residential property market very bad, can't sell anything, property cannot sold. But then we have office also. Maybe the market is growing good in the office market. Then your office rental, you are getting more and more. So you are getting better and stable rental as compared to property. Okay, so this is the first competitive advantage that REITs actually have. Okay. And then the second advantage is, of course, small capital. Oh, sorry. Small capital, you can own big things. Okay. Meaning to say, for example, if you would like to buy industrial land, okay, not just the land only, you only need like probably more than 300,000, 500,000, something like that, just to prepare for the land. Okay. Not talking about like building up the factory, just talking about the lands only. You need that kind of money already. But then for REITs, the best thing about it is like even you only have like 1,000 ringgit in your hand, you can own all this asset all together. KLCC, malls, factories, warehouses, commercials, all these things. So this is also the best competitive advantage that REITs actually have as compared to properties. Because properties, they need big capital, whereby REITs, no. Okay, you only need like small capital, you can own a very, very good asset. Okay. And then the third thing, okay, this is my favorite advantage that REITs actually have, which is they actually have professional to manage for you. Okay. Like for example, our properties, if let's say we do it all by ourselves, DIY, okay, definitely we have a lot of troubles as well. I always have this comparison to my clients. Sometimes I just tell them, I say, you always like to be a property investor, but let me give you a different comparison. Let's say today you have like 10 millions kind of a capital. You want to invest into assets that give you passive income. 10 million put into these properties itself, you will be very troublesome, you will be very headache. because every month you'll be just busy going there collecting rentals, and sometimes maybe the tenants they have problems with their properties. Then you have to go and settle the things also, repair, maintenance, and all these things. Sometimes even you meet some bad tenants, then even worse, you have to go and settle by the court or the legal terms like that. So all this thing, all this hazard, it will be very trouble for you. Maybe you think about like, I will hire a manager myself also, but then it costs lah, you know. The manager, you have to pay him salary, and then this kind of manager is not cheap also. You have to pay like monthly, probably like 6,000, 10,000, something like that. So this is a huge thing. But if you compare to REITs, it's a different story, because 10 million you just put into like different kind of REITs. Then you don't do anything at all. Every quarter you just receive the rental, you receive the distribution. Okay. So from here, you don't have to hazard to manage all this thing. And then these kind of properties manager, they're expert as well. They're expert in managing. Then they do not manage just like residential 1 unit or 2 unit. They manage like the whole mall of it, the whole building, office building. So they're definitely good or even better than us. Okay. So this is the best, I would say the best advantage that REITs actually have as compared to property asset itself. Okay. And then this is also a very, very good advantage as well. REITs, they have, it's what we call liquidity. Okay. So the same scenario, the 10 million that you invest into property, once you invested, you're waiting for passive income. But what if one day suddenly you found out that there's a business opportunity, you wish to liquidate probably like 2 million of it or 3 million of it. So using properties, it will be very hard for you to liquidate it, because you have to sell, put up sell, find the right buyer. But for one property, you want to find the right buyer, probably takes like months or so. Even the process itself also takes months or so. So definitely this is very headache for the owners. But through REITs, it will be a different story, because the REITs market, they always have volume, they always have liquidity for you to just buy and sell. Very easy. 1 day, 2 days settled. So you need like 2 million, 3 million. Look into your properties, look into your REITs. You can just put up sell order, and then within like maybe 3 days, 4 days, you're able to get your money back at it. So this is also the best thing that REITs have as compared to properties. Okay. So all this advantage altogether, definitely we can say that REITs, they have better risks as compared to properties, because it's very easy for you to manage, and it's very easy for you to handle situation with REITs. Okay. So as I say just now, okay, REITs is relatively stable income producing assets as compared to properties. Okay. In property investing, you bear all the risks yourself. You have to settle everything. Okay. While in REITs, you spread out the risks. Different assets, letting a experienced manager to do the work, and just enjoy the passive income. Okay. So this is what we call like REITs investment. Okay. The best thing about it. Okay. Now we will talk about the types of REITs. Okay. The types of REITs. So REITs, if you do not go into like different kind of properties, we just talk about like the types of it. Actually, if you Google up, they have a lot of different model of REITs. Okay, to specific, it has like equity REITs, it has like hybrid REITs, and it also has like mortgage REITs. Definitely for the bottom two, hybrid and mortgage, it's not that common. Okay, in Malaysia, most of us we have is what we call this equity REITs. Okay, not this mortgage or hybrid, but these two types, usually it's more popular in US or in other countries like maybe Singapore like that. Okay, so you were able to find all these different REITs. But typically to say what are they, it's also the same thing as the name itself. Equity REITs, it's the normal REITs that we know from Bursa. Okay, you know about Sun REITs, Sunway REITs, all this thing, or maybe like KLCC REITs, Pavilion REITs, and all this. But whereby mortgage REITs, it will be a different kind, whereby it's more on they own the assets about these mortgages, because in US, for example, it's much more advanced, their markets. So they have all these mortgages from these banks. So usually what they will do is like they will sell this mortgage to the investment bank, and then the investment bank will do something about it to make it what we call, as I mentioned in the beginning, securitization. Okay, they will securitize, make all this into one assets, then give out the income, give out the rental, something like that to the investor. Okay, hybrids is the one that actually owns both of it. Okay, they invest into properties, real estate, okay, as well as the mortgage. Okay, so this is why like mortgage and equity REITs. But for today, definitely we will just focus into equity REITs. Okay, equity REITs is the one that in Malaysia, in Busan, Malaysia, most of it, everything, all of it is equity REITs. Okay, but if we look into equity REITs, right, they have a lot of different types of it. First of all, we have commercial REITs, okay, and then we have industrial REITs, healthcare REITs, retail, hospitality, residential, data center. Okay, so as I mentioned here, the name of it will be then the REITs type lah. Okay, but then they also have different kind of a risk level lah, definitely. So for example, just to give you guys an idea, industrial REITs will be the one that always what we call go together with the economy. Okay, meaning to say, like for example, our economy, our Malaysia economy, it's all about export and import. So definitely, if let's say Malaysia export is booming, right, then you know lah, industrial REITs is the one that will grow more and booming lah. Okay, so industrial REIT, they have like warehouses, manufacturing, industrial business park, and all this. So in Malaysia, we do have industrial REITs. Later, I will point it out for you guys. Okay, and then we also have like healthcare REITs as well. So healthcare REITs is much more like the one that involved into hospital, okay, like KPJ, all this, okay, as well as like living wellness and all this, nursing homes. So typically the properties of healthcare REITs, it's much more defensive lah. Okay, as you know, healthcare is the one service that we will definitely needs whenever even like market is booming or market is in the depression or something like that. No, we always need healthcare REITs. Okay, and then we also have like commercial, retail, and hospitality. Okay, so this three is much more on the it's also slightly similar to the industrial REITs. It's more on like the commercial, like the shopping mall and all these things. Retail REITs, commercial is more office, sorry, not the shopping mall. Retail one is the shopping mall, like for example, your pavilion REITs. Commercial REITs, for example, is your KLCC. Okay, so these type of REITs, they will have different business trend then. For example, commercial REITs, the offices, they have in this time, I mean, like for example, our post-pandemic era, we have a lot of different business. They start to have work at home, work from home culture. So because of this culture, to be honest, office REITs, it's getting not that advantage, okay, not that powerful anymore, not that competitive anymore. So commercial REITs is much more like right at the moment, it's much more having the lower price like that. Okay, so retail REITs is more about like the shopping mall. Okay, so this is the one REITs that actually they usually have. We all easy to understand, like for example, Mid Valley, Pavilion, and all this. Okay, hospitality REITs, this is about hotel. Usually it's very bad during the pandemic time. Right now it's on recovery. Okay, pretty good as well. Okay, recent performance. And then also the last one, I think this is recent trends. So after the post-pandemic, Malaysia also starting, we have a lot of REITs company, they started to invest into this data center REITs. Okay, so basically what they do is they manage data. Okay, they have facilities that actually owns the servers and also the data. This will help us to, you know, for example, this data center REITs usually is much more common in Singapore. Okay, but in Malaysia only right now only we started to have this kind of a REITs. This is a much more like a newer trend in Malaysia. Okay. And then if you look into Malaysia's REITs, this is all the Malaysian REITs that we have. Okay, so if you really point it out and there's like 9, 12, 15, 18, around 19, around 19 REITs, okay, in Malaysia. Okay, but I can tell you most of it, it's about a few types only. So the first one, definitely the commercial REITs, office REITs. So a lot of them also office REITs, like Emphas, it's about the M-Bank REITs like that. Okay, and then we have like KLCC. We also have like UOA REITs. Okay, all these are commercial. Okay, as assets, this is industrial, the second type. Okay, so assets REITs, and if I'm not mistaken, I think Central also, KIP REITs also. This few. This is retail as well, retail and industrial all together. Okay. And then we have our retail REITs, shopping mall. So shopping mall, they have a lot, like IGB, this is for Mid Valley, Pavilion REITs, Sun REITs. Sun REITs is more like what we call a mix of it. So they have a lot of different types, properties as well, hospital as well, shopping mall as well. So different kind of REITs. Okay. And then definitely we have medical. Medical is Alaka. Okay, Alaka REITs. And this YTL is hotel REITs. Okay, so they have different kind of REITs. I would say many kind. But to be exactly right, what kind of REITs is much more quality? So here I can just point it out. Most of it, to be honest, if you guys go through it one by one, you'll find a lot of different REITs. They do not have much performance, and dividend is not that good also. But typically, the one that actually quite quality one is exit REITs. This is about industrial REITs. So usually, like for example, you can see that whenever you have market crash, right? This is the REITs that you can just go into it, because asset REITs, you do not have to worry about it. They are industrial properties. Basically, the rental is all full out 100%, and then it's quite stable also. Okay, and then Sun REITs also. Sun REITs also is one of the I would say much more popular among the people. Okay, among the REITs investor, because to be honest, REITs, Sunway REITs, they have this kind of features that what we call is called sponsor. Okay, because different kind of REITs, they do not have, many times they do not have sponsors. What we mean sponsor is means like they do not have, like for example, a big property developer behind them. Okay, which the developer, they will always keep on finding new projects and finding new assets. Okay, so once they build out the assets already, what they can do is they will just sell the asset to the REITs. Okay, and from here the REITs were able to receive more rental, and then for you guys as an investor, you're able to receive more distribution. Okay, so this is the type of management that we look for, which we will found that the REITs will actually grow and grow better and better, giving more and more dividends. Whereby, like for example, KLCC, although it's a very quality REITs, the office is basically occupancy rate very high as well. It's a good REITs quality, and basically their rental, their tenants, all of them are like international companies. You're not worried about it. But to be honest, KLCC REIT, it doesn't have growth anymore, because they do not have like acquiring assets. They do not have a sponsor behind them. So that's why these are the types of REITs that we say that do not have any sponsor. So when they do not have sponsor, that means that the growth is not there. They will just follow on the rental growth only. Okay, they do not have like personal growth, something like that. Okay, so 19 REITs, out of it, I can say probably like this 1, 2, 3, KIP is okay, 4 asset REITs, UOA REITs also. So these are the one that you can see the name of it, you straight away you know their asset is, big asset, good quality asset. These are the few REITs that actually okay only. But the rest of it, to be honest, for my opinion, I think this is so only, not that competitive, okay, not that attractive to me. Okay. Okay, I can see there are a few questions here. Let me look into it just for a while. Okay, I think first question is about REITs Underbursa is really good enough to hold long term as my REIT portfolio are underperformance, except IGB and Sun REITs. Also, KLCC is also not showing that the benefit of holding REITs. What's Bursa rules on monitoring its member? Okay. So you're asking like what kind of a REITs is the good one? Okay. So this guy actually owns like IGB REITs, Sun REITs, AR REITs, KLCC. So I would say, like just now, as I mentioned, since you already invest into REITs, I would say that the one question that you can ask yourself is which REITs actually have the one that we call sponsors. So you see your IGB REITs and Sun REITs. Okay, IGB also not that the sponsor is not that active lah. Okay, although they keep on building assets, but their sponsors not that active at building even quality assets and sell it to IGB. Only Sun REITs, I would say the sponsor is much more active, providing like just I think like last 2 years they provide medical REITs, okay, medical Sunway Medical to the Sun REITs. Okay, so this is what we call like having a sponsor. Okay, having a sponsor that actually keep on building assets, building the building for you. Okay, so and then you were able to receive the growth lah. So this kind of REITs is much more better as compared to like as I mentioned the KLCC. They do not have any growth. So even you're holding it, you're earning the dividend, yes, but do not have any growth lah. Just normal dividend, 6%, 5%, something like that only. Okay. And then the second question is even property counters just listed on Bursa recently also dropped more 30% after IPO. What's the benefit to continue to hold on KLCI? Yeah, basically I agree about that also. As you can see, this is a different question. Property counters is having a different trend. Okay, so as compared to REITs, properties most of the property company in Malaysia, let's say they listed on stock market, most of them they are on residential market, which actually at the moment is quite saturated, and then it's very hard for us to get growth anymore. So I agree, but I would say the REITs on Malaysia, they still have some hopes. Okay. Okay, the third question is distribution received from REITs is subject to income tax. Yes, this is also a good question. So this is the thing that I will go through later on. So the things that you need to know about REITs. Okay, so I think the question 3 of it I answered it. So we will just go on for the section. Okay, so coming to the fourth section, we will now talk about the things that you actually need to know about REITs. Okay, so we will try to spend more time here. And these are what kind of things are this? This is basically, first of all, we'll talk about the valuation. Okay, how do you value? How do you find a good REITs and all these things? Okay, all these skills. But also there are things that very crucial to us also. It's about the tax. Okay, so typically to say, in Malaysia we do not have stocks kind of a tax like your dividend, your capital gain. No, maybe next year capital gain we might have it. We're not sure about yet. But dividend at the moment, no, we do not have dividend tax. Okay, but for REITs, right, it's a different story about it. Okay, it's because for REITs, they do have this requirement. Okay, it's more like I would say it's almost like a legal requirement. Okay, because what their business is about, it's just about managing property and receive the rental. Okay, so this is all the business just about. But then the rental that they receive, they cannot say that, like the property manager, they cannot say that, oh, I received the rental already, I plan to reinvest all this rental to grow the property. No, they cannot do so. Okay, like for example, they receive 100 ringgit rental. What they can do about it is just to pay off the expenses, to pay off the manager, to pay off the workers, the employees, and all this thing, to pay off the trustee fee as well. And after all the expenses, the crucial expenses, 90% of the income, 90% of the profits, they have to distribute it to the shareholders, okay, to the REITs investor, 90% of it. Okay, this is like almost a must thing, okay, because if they do not do so, just for 1 quarter only, then they will start to bear the tax. Okay, they will start to have the tax. Okay, meaning to say REITs itself is actually tax exempted. only if they keep on providing the 90% of the income as dividend to you all. Okay, so as long as they keep on doing that, they will stay tax exempted. They do not have to bear the tax. But then, you see, the profit, the REITs itself, they do not pay the tax. But still, at the end of the day, you got to tax something, right? Because government. So on our side, on our investor side, then we have to pay the tax lah. But the tax is much more lower as compared to like business tax itself. So for our side, when we receive the dividend, we have to pay 10% of the withholding tax. Okay, so 10%. Okay, so typically, whenever you invest into REITs, for example, let's say they are REITs, they have dividend yield of 7%. So usually I will take off a 90%, I will take a 10% discount. I just calculate 90% only. So meaning to say 7% dividend yield, it means that at the end of the day, they will give you the net dividend is 6.3. So you gotta have this mindset in your to whenever you invest into REITs like that. Okay, so bear in mind, REITs, they do have tax. Okay, and then we will talk about how do we find undervalued REITs. Okay, so to find an undervalued REITs, typically, as I mentioned just now, keep on repeating, REITs, it's all about property. Okay, so to find an undervalued REIT, it also means that to find an undervalued properties. Okay, so they have the same meaning of this lah. Okay, so if you want to find an undervalued property, the first thing first that you need to bear in mind is that the price that you pay must be lower lah. Okay, for example, your property, you see that this property is actually in maybe not that cities area, okay, maybe slightly at kampong like that. But then the price they sell almost like city price like that. Maybe the surrounding they sell only like 200,000, 300,000. But then the new condo they sell for like 600,000, 700,000. Then definitely crazy lah. You're not gonna buy the property that one. Okay, even they spike it up the the story saying like, wow, what kind of a gym they will have, what kind of a facility that they have. Who cares, man? The price is still expensive. Okay, so for property we look at the price straight away. But then for REITs, then we can look at the price to book ratio. Okay, because for REITs, they also have this requirement, which every year, by year end of the financial year, the end of the quarter, the last quarter, the fourth quarter, they will have to revalue their assets. Okay, so what does it mean? In that, for example, like KLCC, let's say we give the value saying that KLCC right now is worth of maybe 600 billion. Okay, but the thing is, in normal accounting, let's say 600 million in assets, we do not have to revalue the assets every year. Okay, we do not do so in normal accounting, normal other company kind of accounting. But this thing is different in REITs, whereby they are required to revalue their assets every year. Okay, so for example, let's say KLCC this year, it happens some kind of accident, maybe fire accident or all these things. So you will then understand KLCC value will then drop slightly. Okay, maybe from 600 million to probably like 590, 580. Loss of 10 million or loss of 20 million. Okay, so only with repair and replacement, then only the KLCC will back to the condition. And also they will pick up the confidence level also. Then only the asset will then revalue again in the future, whereby the value is gaining up back. So this is what we call like revalue. Okay, but what I'm trying to say is, because the REITs, they will have to revalue every year, right? So that means that the book asset value, okay, the value that you look into their balance sheet is actually their market value for all these REITs. Okay, so this is what I meant for the book value is actually literally the market value of the properties. Okay. So now you understand about this concept already. You know that the book value of REITs but in the balance sheet is much more different as compared to like other different business company. So because companies, they do not revalue every year. REITs, they have to. Okay. So with the market value there, what you have to compare next is basically the price lah. Okay. So if you calculate book value per share, let's say right now it's 2 ringgit. And then the company, their shares, their REITs actually selling at, let's say, 3 ringgit. That means the book ratio, price to book ratio is actually 1.5. Okay. So 1.5, that means that you are paying much more expensive. Okay. You are paying much more higher value to actually own these properties. You are paying like 1.5 times more. Let's say if you're owning for KLCC, then maybe okay lah, because quality assets. But let's say you're paying like these REITs that actually owns not so good rental, then you know lah, this is very expensive city. Okay, so this is the first way. How do we find undervalued REITs? Okay, using price to book ratio. Okay, so always bear in mind, we only buy undervalued. That means price to book ratio is lower than 1. Okay, so this is the first thing. And then the second thing is about the dividend yield. Okay, dividend yield, meaning to say dividend yield, your distribution. Okay, every quarter, how much you are getting it. So usually, dividend from REITs, right? They usually different by around, I think, a few percentage lah. But most of it, at least they have around like 3, 4, 5, something like that. Okay, but I would say most of the time, I will encourage my clients, I will encourage my students also. I say, if you want to buy a REITs, might as well the best one to buy is having a dividend yield of higher than 5%. So that is the one that you can see, oh, it's undervalued. Because if you're buying lower than that, right, then I would say might as well you just buy other dividend company. It's much more better also. So usually the one that I will aim for is maybe 7%, 6%. So let's say my REITs, for example, asset REITs. I remember back then in pandemic time, because we are locked down, right? We're having lockdown pandemic, and then everyone at home, they will just keep on ordering things. So the industrial company, the warehouse company, they are full of business. Okay, their order books are crazy, backlog, super high. So their business will booming lah. Okay, so the REITs rental is also higher. But then I remember the asset REITs, back then it grows in value now. Okay, from I think 1 ringgit 80 cents, something like that. It's not mistaken, around 180 or something. It grow until like 2 ringgit 20 cents, something like that. Even higher, I think. Then the dividend yield, they comes to like probably 5 each or 4 something. So this is the time that you know, okay, this kind of REITs is expensive already. So better don't go and buy. If you are buying at 1.7, 1.8 ringgit, then okay, perfect. The dividend yield is better. The dividend yield, when it grows, it's like 7%, best thing for you. But then once it comes to the level that the dividend yield is lower than 5%, then it's very, very bad. Because you have to imagine, you have to give the tax as well. 5% dividend yield, that means like 4.5% only to you. So not a good thing. Okay. So first thing first, finding undervalued REITs. Okay. 2 indicators. One is the price to book ratio. The second one is dividend yield. Okay. Okay. Finding undervalued REITs. It's about looking at the market value, looking at the valueness. But then, how do we find a good REITs? Okay. What about whether the REITs is quality or not? Okay. Usually, I will then give out 3 indicators. Okay. Although there are more, but in today's session, let's talk about the easy way. Okay. So these 3 indicators: occupancy rate, rental yield, and debt to asset. Okay. So how do we find all this data? Okay, actually it's very easy. Look into their annual report. Okay, you go to Bursa Marketplace or KLSC screener or i3 investor, whatever different kind of platform you have, go into that, look into their annual report, try to read on. Then you will see all these terms: occupancy rate, rental yield, and debt to assets. Okay, so first thing first, occupancy rate. So definitely, for example, you own a condo. You want to have the condo that actually rent out everything. Okay, the occupancy rate is higher than 80%. If you're having properties that actually having occupancy rates maybe 70, 60, for example, MREITs, MFirst. I remember that one REITs MFirst, right? They always have dividend rates, probably like 7, sometimes 8, 9%. Crazy. So as I say just now, right? Undervalued REITs, what? Dividend yield higher than 5%. But then, is it a good REITs? No. Because if you look into their occupancy rate, yes, they have like different kind of office, but I think only 1 or 2 is occupancy rate much more higher. But the rest of it is like what, 60, 70, something like that. Okay, so that is how you identify whether this is a good REIT or not. It's, let's say it's less than that, oh, very, very, very bad, because that is not the one that you wish to have. Okay, and then the second thing, occupancy rate, it's about the stability of your rental. But then, if you want to have your rental keep on growing, at the very least following the inflation, then you have to look into the rental yield. Okay, so usually I will look at rental yields that actually higher than 5%. Okay, so rental yield, definitely you look into the annual report, they do not straight away stated there saying that, oh, my rental yield is how much. No, you have to calculate yourself lah. So how do we do so? Very easy formula. When you look into their annual report or quarter report, they will have like net property income and revenue and all this thing. So they also have investment properties, meaning to say the market value of the properties. So what you do, you just divide it, net property income divided by the investment property, just like how you do for your property as well. For example, your property, you receive rental every month, 2,000, and then your property is valued maybe like 500,000. So what you do, you should just put up annual rental, 24,000 divided by 500,000. Then you will get the rental yield. Okay. So definitely you try to look for rental yield for higher than 5%. Okay. Why? Because that means that this company is actually doing a good job to maintain the quality of the assets, to maintain the quality of the real estate, and it can give out a higher rental yield to you guys. Okay. So if you find that the assets is actually providing only 3% or maybe close to 4%, then not that well. You know that means their assets, right? Maybe the manager is not doing a good job. Okay, not doing the right thing to try to attract more tenants, and the rental yield is just competitive, hard to play around. Okay, so always we will look for rental yield that is higher than 5%. Okay, this is a key thing as well. Okay, and then the last thing, it's about the debt to assets. Okay, but this one usually I do not put too much of emphasis. Okay, because REITs, okay, they also have another key requirement. Okay, REITs, they usually have a lot of this requirement required by Bursa. Okay, so this is also one of it. The debt to asset should not more than 40%. Okay, it used to be 40%. Right now, I think I'm not sure whether they changed it or not. During the pandemic time, our Bursa Malaysia, they actually allowed it up to 50%. Okay, 10% buffer. Okay, but I would say the best will be just following the traditional level will be better. Okay, not more than 40%. Okay, meaning to say your total borrowing divided by all of your asset should not more than 40%. Okay, this is required by law. Okay, if not, then they will breach, and then they might lose their tax exemption as well. Okay, so most of the REITs, I can say in Malaysia, they actually maintain this thing. But I do come once in a while. I do come along see that some of the REITs they actually have higher than 40% level lah. Maybe 43, 45, something like that. So it's not a good thing because first thing first, REITs, as you know, they give out 90% of the profit as dividend. Okay, so that means that they do not have growth on. Okay, they do not have growth. The growth comes from the management level. Okay, comes from the management quality, and also another one is from the sponsor. Okay, but then you have to understand the sponsor, for example, like Sunway Group, whenever they sell asset to Sun REITs gotta pay something, right? But then they cannot have like, for example, oh, I kumpo the money already. I have like 200, 300 million. I go and buy the asset. No, definitely they can't do so because they 90% of the income they have to distribute up. They do not have any money left for them. So whenever they want to grow, acquire assets, they will definitely have to put up borrowings as well. But then here again, you can see borrowing, they have legal requirement again, lower than 40%. So most of the time, REITs, right, whenever they want to acquire asset, they will have to put up fundraising from their shares, okay? Typically just from the shares. So this also means that they actually will dilute your shareholding value also. So it's a bad thing because let's say they dilute your asset, that means your pricing will be coming down also, okay? So if you come along this REITs that actually have debt to asset higher than 40%, then it will be very bad because you know that the dilution will be even higher because they do not have room to fund from the borrowing, fund from the the banks and all these things. Okay, so typically we'll try to find the debt to assets lower than 40%. If 40% also okay, don't worry. Just not to more than 40%. If it's more than 40%, then it's a bad REIT, not a good sign. Okay.
Dibo, I just want to add on that the SC requirement is below 50%.
50%, right? That means they not yet changed. I think because I remember they changed it during the pandemic time. It used to be 40%. Right now it's 50%. Okay. Okay. So this is the things that I mentioned just now. So REITs are required to pay out all the profits as dividend. Okay, 90% at least. But most of it, you can look into the REITs annual report. They usually pay out like more than 90%, 95, sometimes 98%, something like that. And then to maintain tax exempted, but for investor, we have to pay 10%. Okay, but bear in mind, because of this thing, okay, it's a good thing because they pay you dividend. They pay you 9%. They confirm the dividend. Okay, but then bear in mind, if you want to invest into REITs, they do not have much capital gains because for them to really improve the share price only coming from two sources. One, from the sponsor. Two, from the management quality. Okay, so if you really want to look at the best REITs, I can say at the moment, Sun REITs is the one. Okay, Sun REITs is the one that actually I can see a really steady growth. They have the sponsors. They also have the quality to manage as well. Okay. Okay, we will then come to the importance of REITs in your portfolio. Okay, so why is it important for you to include REITs into your portfolio, especially your property portfolio? Okay, so these are two things. First thing first, stable passive income, and then risk diversification. So stable passive income, REITs itself, it's like a FD. Okay, it's like a property replacement. Okay, so instead of putting all the capital into FD just to save money, right? Or maybe just into properties, because usually I think in Malaysia it's very special case because all of us, I think from our family, our parents, from whenever we are small or something like that, they will always try to instill the idea of property investment. So they will say that, oh, property investment is the best one. Try to keep on having, go and study a degree, get a good job, high paid, go to the bank, say that you want to buy properties. What kind of properties? Don't care, just buy. because along the time it will grow. But is it the real case like that? But I can share more a little bit. It's about the property markets. It's very different right now as compared to like during our parents' time. Okay, back in like in 80s, the 90s, or maybe 2000s. It's very different. Being said that, because in Malaysia economy, we have gone through the high inflation areas. Okay, we have gone through that areas whereby most of the properties back in the very early stage, right, they are very cheap. But then why actually somehow they experience a huge growth of it? It's all because of inflation. Property, yes, definitely they have growth as well, but so the most important things about properties are it's always about inflation. Like for example, last time you used to have like few cents copy. Right now we have like 2 ringgit, 3 ringgit. Okay, this is what we call inflation. So property investment is all about inflation, and then also a little bit of economic growth. So making like, for example, an area of, let's say, Selangor. Sometimes in PJ, we are not that modern. Okay, right now at the moment, as you can see, there are a lot of high building, high skyscraper as well, and then all these things. So you can see that a lot of big buildings there. So the growth is definitely there. But if you want to have like all this kind of happening to really happen on your property investment, I would say right now it's very saturated. Like for example, if you buy PJ area property right now, the price is actually too high already. And then if you want to have this kind of growth, probably not gonna happen in the near terms because it's very saturated, and then the growth is actually like on full terms, no more, not too much. So you only having the inflation only. So the growth is not there. So instead of like putting everything into one basket into properties, I would say that buying into REITs, it'll be a different case, because instead of just focusing on residential properties, you can then have commercial and all these things, office as well, grow together with the economy. So maybe, for example, industrial properties, it's a very different things, because industrial, sometimes in Malaysia, maybe we can have this growth lah. For example, in Penang area, we can see that Penang area is growing as a semiconductor state like that. Okay, so the semiconductors is the best export in Penang. Right now, Penang is very, very booming for that. So if in the next 10 years or 20 years, Penang, they actually grow even higher level. They move up the value chain, producing higher level chips. So then you know lah, the industrial properties there will be crazily higher growth. So this is what we call like a stable passive income. Like you can just receive this kind of a passive income, okay, much more stable for you, and also having the stable growth as well, rather than just keep on focusing on properties itself. Okay. And also very important thing, liquidation at arm's length. Typically to say you want to liquidate, you just liquidate. If you have an emergency to solve, it's very easy for you to just use REITs to do it. Rather than property, then you have to sell, and then you have to hire a lawyer and agent and all these things. So very, very troublesome for you. Okay. But of course, also risk diversification, as I mentioned just now also. You can have different kind of asset class. Okay, for example, in COVID 2020, some REITs, as compared to other kind of stocks, stocks they drop at least 30%, but some REITs they only drop for 15%, and they recover very fast as well after that. And also another thing about it is, for example, if we compare to property, back in COVID time, crazy. Your tenant will come to you, say that boss, cannot. No job. Income cut half, cannot. But in REITs, right, then you see your risk level is diversified. You don't have to worry anything. They still give you the dividend, they still give you the distribution, maybe slightly lower, but still okay. And at the moment right now, they grow better also. So this is what we call like risk diversification, for you to really have the better risk management as compared to invest into properties instead. Okay. Okay. think my section is over already. So I can see a lot of questions. Maybe I'll try to answer
All
all
right.
the.
So you'll just move on to the question and answer session.
Yeah.
Thank you so much, Dibo, for the sharing. So if
No
you have
worries.
any question to ask our speaker, please write them at the Q&A box. Okay, write them at the Q&A box, not the chat box.
Yeah. But see, chat box, they still have a lot also.
Yeah. So transfer those questions from the chat box to the Q&A box, right?
Yeah.
So the first question is by Steven. How is the REIT's performance as compared to property as an average like 10 years period?
Oh, okay. Okay, I would say for this one, right, I did a research on it before. Okay. To be honest, I was very interested on REITs back in my beginning time of investing into stocks. So this is the first area that I actually do research for it. But to be honest to you, right, REITs performance as an average of 10 years time, right? If you really just compare on capital gain only, I will tell you very different. Some of the REITs, they just stagnant. Some of the REITs, they even drop in price. So you have to be very careful with it, okay? Like, if I'm not mistaken, M-First, as I mentioned just now, the one that M-Bank officers have, okay? That REITs is not that good, okay? Because the capital gain is not there. I think the price is also drop also. Although they give you like the dividend, whoa, providing 7%, 8%, something like that. But as you know, dividend yield, it's a calculation of dividend divided by your share price. So if your share price keep on dropping, definitely your dividend yield will be higher as well, calculation, mathematics. Okay. But if you compare REIT's performance, including the dividend for a 10-year period, right, as compared to properties, so I would say definitely REITs is much more, stable, and the performance is actually okay. You can achieve like 7 to 8%, and even higher if you're putting out more compounding. Okay. Let's say for example like Sun REITs, I remember the capital gains is almost close to 100% like that. Okay, for 10 years time, and then including the dividend, then you definitely higher than that, 10% something like that also can. For property, then it's a different story. Okay, property, if you buy into a good one, then okay, but I will tell you, my clients, what I encounter, okay. Most of my clients, for example, whenever they talk about property investor, a lot of people will be very hyped. They think that property investment is the right one, but I would say not really the case. Like for example, most of us, we will think about buying properties, then we go and buy the developers' properties, like big project, new project, massing or and all these things like that. But I'll tell you, that is the worst one, because just imagine a single condo blocks, maybe we put up like hundreds unit of it. Do you think that you are the only one that actually buy and invest, try to rent it out? No, probably 100 units of it, close to 50%, they are actually invested. They are trying to rent it out as well. And then once the property project completed, the first thing first you want to do is renovation. You will just keep on rushing to the contractor and then try to do renovation. The contractor, they have a lot of business, so they can charge you more. They charge you more from there, and then you try to rent it out. So you have to compete with other people again. Then the tenants come to you, the tenants say that, oh, you put up 2,000 rental, but the next door, they say 2,000, they can give me like a new sofa, a big TV, all those things. They try to request more. So you have to put up more capital. So this is the things that I found a lot of property investors, they have the problem that they face. Okay. So if you want to invest into property, yes, it's a good thing. Okay, I would say property investment is still good. I trust on it. I have a lot of research on it as well. But the thing about it is, try to really do more research and invest into properties. Then only you will have a better return as compared to REITs. Okay, if not, most of the time properties, they will just, my client always complain to me like saying it's a very huge commitment and a big asset that actually stuck my money inside. So not a good one, something like that. Okay. But I would say, if let's say onto this question, property investment, definitely the performance higher than REITs, but the risk level is way crazy high as compared to REITs. Okay.
Thanks, Dibo. The next question is, the REIT's performance are affected by the market sentiments. So what is your take about it?
Okay. This is true as well. Okay. Meaning to say, because REITs itself is also stocks. Okay. So definitely, for example, whenever we have like market crash and all these things, your REITs performance will drop. But I would say stock markets, it's a irrational market. Okay. So typically REITs, as I mentioned just now, their business is just about property management. Okay. So try to have a mindset like that. If next time you found that the market sentiment is bad, right? For example, let's say some REITs, the market sentiment is so bad that actually people are selling stocks, they don't like stocks. And then some REITs also affected, come down in price. So straight away, I would say that this is an opportunity. Okay, because the easiest way you should look at it is that you should not just look at the price. Instead, you should think about like Sunway, how would the market actually affect them? Is the economy is really that bad, making like the Sun REITs maybe making the property management to be in trouble? Is really like that or not? So if it's not that case, right, then it's okay. Then we can invest. If let's say it is actually economy is bad, maybe some way they have debts problem, finance problem, then it's bad thing. Then we don't want to invest into REITs. So this is the thing that I can share. Okay. But typically REITs as compared to other kinds of stocks, it's not very volatile also. It's just that you have to find the right REITs. Okay. If you get the qualities one, I would say the performance is much more consistent. Not that roller coaster like that.
All right, thank you so much, Dibo. Just now you mentioned that there are a couple of types of REITs like commercial, residential, healthcare, retail, data center. So how do we identify which one should we choose for investment?
Okay. For this one, to be honest, they do not have a very huge difference. Okay. But typically you can just think about the economy cycle. Okay. The economy cycle. For example, like if you want defensive kind of a REITs, then I would say like healthcare is the one to go. And maybe industrial is also okay. Okay. Try to find the good industrial like asset REITs. If you find the bad one, then probably not the one. Okay. If you look at like for example commercial, as I said, commercial is not the right one for the trend at the moment because we still have all this work from home culture and all this thing. So even like for example KLCC, they also slightly affected also. Okay, so they definitely for companies they have this kind of idea, this kind of culture try to implement. So not the good one that we should always look at lah. Okay, so how do you identify? I would say it's not really like identify or anything like that because invest into REITs, you do not try to put up short-term investment, buy and sell trading on it. No. Most of it I would suggest just to hold on it for passive income. So instead of looking at which types to invest, I would say look at the quality of it, the REITs, whether their occupancy rate is good, whether the management actually managing well, rental yield is high. So all these things is much more important.
Thank you so much, Dibo.
Yep.
The next question is asked by Tai Leong. Now, earlier you mentioned that we need to pay 10% withholding tax. So the question here is, how do we pay that? Is it part of the personal income declaration to LHDN?
Oh, this one it's very easy. Typically your dividend when they distribute to you, right? Then they will just straight away take off like the 10% tax of it. So for example, let's say they give out per share 1 cent, then they will withhold 10% of the dividend distribution. Okay, 10% of the distribution, and then they will just give out to you like 90 cent, 9 cents, something like that. Yeah, so you don't have to worry about the LHDN things because you definitely paid it whenever they distribute to you. But this is how they work for REITs.
All right, thank you so much, Dibo.
Yep.
The next question is asked by Kok Long. Can you talk about REITs exchange traded funds? Can you comment a little bit about that?
Okay, REITs ETF. Okay, so REITs ETF, it's it's, I would say it's the same thing as REITs, okay? It's the same thing as REITs. It's just more than like, for example, instead of like focusing on one REIT or another, it's more like this ETF is then means that you hold a bunch of it, okay? Hold a bunch of REITs. So this will then gives you even more assets ownership. Like if you, for example, let's say we talk about REITs ETF in Singapore or something like that, then you will straight away own a lot of assets in there and just get passive income. But to be honest, for REITs ETF, right, I would say the idea of whether to invest into this ETF or to invest into a single REITs, it depends on your take, whether you want to trust on the company management quality, or you just really want to look at the markets itself. Okay, for example, I come along some of this ETF, they say that ETF is much more better, but for me, I have the idea that saying ETF, they will also have more, expenses as well. So as compare, then the distribution wise, maybe the distribution will be slightly lower. Okay, so you still get dividend, okay, but definitely maybe as compared to Malaysia's a single company, then the growth is lower as well. But definitely, if you want to go for others country, like for example US, I would say this is also the better way, because you do not know, like for example, whether this asset, this mall, this shopping mall is, having a lot of footprint in that area, because you are not there, right? So this is also the way that if you invest into different country, then I would suggest going for REITs ETF. Then it's a smart way as well.
All right. Now, Dibo, earlier you mentioned about a few criteria to evaluate REITs. So the next question is, would you recommend us to use price to earnings ratio to evaluate REITs?
Okay, price to earning ratio, I would say it's not too relevant to REITs. Okay, being said, why? It's because REITs itself, right? If you want to look at price to earning ratio, most of the time we'll talk about the growth of the company. Okay, whether the company is actually having, coming months there will be more order books, new project, and all this thing. So then we have an idea. Oh, the earnings will be growing. So this is how we have the idea of looking at the price to earning ratio. But as I mentioned just now, REITs, it's all about property management. Okay, it's all about property investment. So the only thing that you need to care about it is whether you are buying expensive or you are receiving the sufficient rental for you. Okay, so that's why I would say price to earning ratio is not too relevant for REITs. As REITs, we do not expect like, oh, huge rule coming or here and that. No, we do not do that. We only look at the price, the undervaluedness, and then the rental. So price to book ratio and also the rental yield. So these two things will be much more important.
All right. Could you tell us a bit about how does interest rate impact the performance of REITs?
Okay, so this is a very good question. Okay, I remember back in late 2021, I was telling my client also, I was saying that REITs, if you guys still own it, try to not buy too much at the moment right now. Okay, because moving into 2022, we have higher interest rate and all these things, then it will be a bad thing for REITs. But okay, to comment on this interest rate things, right? It's not to say that when it's higher interest rate, then it's bad for the REITs with the borrowings, okay? Because as I mentioned just now, the SC requirements is 50% of the total assets. So meaning to say your debt level, you won't find a REIT that actually have like 100% debt to asset or maybe higher than that or things like that. So most of their debt to asset ratio will be just close to that 40, 50, something like that. So meaning to say all of them is having the same situation. Okay, it's having the same situation whereby the debt borrowing is not too crazy high. They can manage themselves easily. Okay, but higher interest rate definitely is not to say a good thing to the REITs. Is because first thing first, of course, because let's say you have higher interest rate, then your interest payment will be higher as well. So this will definitely hurt your dividend because you're paying higher expenses, just like your installment, okay, your property installment. Right now at the moment, maybe your installment is lower, but then when interest rate is higher, it comes to the cap, then maybe your installment need to pay more. Okay, then you definitely hurts your cash flow. So this is the common things. But second things is the one that REITs will have disadvantage as compared to properties, which is if our interest rate is higher, then you will see the share price of the REITs may be affected easily. How to say so? Because you have to understand, REITs, their dividend maybe is close to 5, 6, then it's a good one. But if you come along, this REITs, they're actually having 4% REITs, right? So try to imagine, let's say 4.5 or something like that, after tax 4% dividend, 4% distribution. But with higher interest rate right now, you can just put up into fixed deposit and get 4% easily. So this will definitely comes out to a lot of investors' mind, and then they will think that, hey, then might as well I just liquidate my REITs right now, and then I can just go for other kinds of assets. So this is why in higher interest rate is definitely not the one that not a good thing for REITs. Okay, it's a bad thing for them. But definitely, if you invest into the quality one, like for example, Sun REITs, Asset REITs, IGB, okay, all this, then it will be much safer, okay, because they usually have a really, really strong investor base, whereby this investor, they won't easily sell. So that's why during higher interest rate, still they are okay. Okay. But if you invest into the bad REITs, then maybe you should be worried for higher interest rate environment. Yeah.
Thank you so much, Dibo.
Yep.
Can you share with us how is net property income calculated? Is it minus deduct all the expenses to manage the properties?
Sorry, how the calculator? What do you mean?
Net property income, NPI. So this is a question by Zaidan.
Okay. How is it how the net property income calculated? Actually, we do not have to calculate it. To be honest, you just have to go into their annual report or maybe quarter report. Look into their profit and loss statement. And then they will definitely state it out. Revenue, other income, net property income, all these things. So typically from there, you are able to know the figures. But to calculate, let's say, for example, the rental yield, then you have to pick up the net property income. They will show you there, and then divided by the investment properties. So they will show you the investment properties in their balance sheet statement as well. So all this information, you can just straight away find in the KLSC or Bursa Marketplace in the platforms. So on their announcement, they will definitely show you.
All right. Thanks, Dibo. So
Right.
let's do one last question on REIT. So how is the market sentiment? How does market sentiment affect the REIT performance? To what degree can it affect the REIT performance, the share price, for instance? Are they very volatile?
How do market sentiment affect the REITs
the REIT
performance?
performance? To what degree are they?
Okay. To be honest, they do not really affect too much, I would say. If you really pay attention to REITs, right? Yes, definitely they play a role as well. Trading sentiment, okay. For example, let's say the market is very, very bad on Bursa Malaysia, very bad on KLCI, then definitely the REITs also will come down slightly. But I would say it will not have like big impact. For example, let's say the price drop by 10, 20, 30%, not like that. Okay. It's because at the end of the day, as I mentioned, REITs, it's all about property management. Okay. Only if your properties market is very, very bad. Okay. Like for example, our back then COVID time, commercial properties, they cannot have people coming out because lockdown. So there are a few quarters of it, our rental is very, very bad. Okay, so a few quarters is very huge disappointment, okay, performance. But then after the lockdown of like 1 or 2 months, then straight away we jump back, it rebounds. Okay, and then you can start to see the footprint coming into the malls and all these things. So because of that, definitely pavilion REITs, then they coming to recovery. Okay, so typically we are not gonna see like the market sentiment really impact on it. It's more on how does the economy actually impact the properties. Okay, like commercial, as I mentioned, the work from home culture, then not that well lah. The industrial one, let's say for example, our Malaysia economy right now, they are focusing on economy madani, and then we are trying to move to the higher value chain for semiconductors. So if this thing really happens, then you can see even more data center REITs, even more higher quality industrial REITs, then you're able to find all better quality REITs like that lah. So then you have better growth, all these things. So this is how we, look at the markets, how will it affect on the REITs itself.
All right, thank you so much, Dibo, for doing this segment for us.
Yep, no worries.
So let me just share my screen.
Yep.
All right, so ladies and gentlemen, you just heard from Mr. Dibo Chua, who is an analyst with Bullbearbursa.